Hey, good afternoon. This is Jay Frost speaking to you from here in the Ether. Of course, welcome you to another session in the Philanthropy Mastermind series brought to you by our friends at DonorSearch. You won't be hearing anything about DonorSearch during this program, but if you are interested in your donors, and I hope you are, you'll be happy to know that you have a friend in DonorSearch, not only to this program, which goes back to 2016, 550 plus programs to just hang around with you and talk about fundraising and philanthropy, but also every day trying to bring us insights about the people who make our missions possible. So if you would, just as a favor to me, check out DonorSearch at donorsearch.net after today's program and just see what they're all about if you're not familiar with them. And if you know them already, say hello. Tell them whether or not you like this program and what you'd like to see in the future. Of course, you can always write to me as well. But that's enough out of me. I want to make sure to take a moment to introduce our presenter today, who is talking about what you can see on your screen, building a financially sustainable nonprofit. And that is Karen Houghton right here. Hello, Karen.
Hey, how are you?
It's great to see you. And of course, I want to welcome you here as well as everybody else in the room. I'm sure you'll be doing that, in fact, through the chat in a minute. And there are two ways that you can use this platform in our conversation today. So after I provide a brief introduction to Karen, then I know we'll want to prompt you to use these. So the first is, of course, the chat. That's your place to play, and I really encourage you to utilize that as a conversational tool between and amongst yourselves and to let us know you're here and living and breathing and enjoying. And then at the conclusion of the presentation, we really do want to encourage you to be a part of this by using the Q&A feature. So you can feel free to use that throughout the presentation, store up your questions there, and then I'll share those with Karen at the conclusion of her formal presentation so she can really tackle those big issues about financially sustainable nonprofits. And so with that, Karen is the CEO and founder of Infinite Giving. You probably knew that. If you have not looked at the website yet, I strongly encourage you to do it. It's an award-winning automated investment platform for bringing better investing experience to nonprofits. And as many of us know in this world, that is so important because it's been so hard for most of us to have these tools available to us, regardless of the size of our organizations, to make it possible for donors to really work with us in a profound way. She advocates for organizational sustainability through better financial management by hedging against inflation, lowering endowment fees, and growing their asset giving. Nonprofits can do more good work and help us all have stronger, healthier communities. You bet that is true. We are so grateful to her. Karen, thank you so much for being here today.
Thanks for having me.
Take it away.
All right, welcome everybody. I am in Atlanta, Georgia, and as a quick just welcome and to see kind of where everyone's coming from, let's go ahead and use that chat feature. And if you get a moment, go ahead and drop in the chat where you are tuning into from. I'd love to see.
And I'll share that with you because you may not be able to see it. So, whoa, lots of responses. So this is great. Let me see. We've got folks from New Jersey and Tempe, Arizona, Dallas, Miami, Lawrenceville, Georgia, Austin, Muscle Shoals, Alabama, Bethlehem, Pennsylvania, Corpus Christi, Bentonville, Arkansas, Brookhaven, Georgia, really all over the place.
I love that. Well, thanks everyone for tuning in. And Jay, where are you?
Oh, I'm right next to Dulles Airport in lovely Northern Virginia.
There you go. Well, we are tuning in from all over the US. We serve nonprofits all over the US, so it is great to have everyone. Today's webinar is going to give you an overview of achieving financial sustainability and hopefully what is an approachable and easy to understand format. I feel like people make it too complicated sometimes, and we don't want to do that. So our topics today are going to include best practices for reserve funds, demystifying endowments, understanding and reducing investment fees, and of course, accepting stock and cryptocurrency donations. I know that's a hot topic these days. The big idea is that nonprofit leaders, we believe, just can't only raise the money, they also have to manage it. So financial resilience leads to better outcomes for the people we serve. So if you'd like to have a financially sustainable nonprofit, you are in the right place today. I'm going to talk you through the journey of 4 key things that you can do to become a financially sustainable nonprofit. And I'm going to leave room for plenty of questions at the end. So definitely use that Q&A feature, and we are intentionally not running the full time, so we can leave plenty of time for the Q&A. So as you're going through, if you think of a question, go ahead and write it in there and we'll get to it at the end. All right. All right, let's get started. All right. First up, my name is Karen. As Jay shared, I'm the CEO and founder of Infinite Giving. We are an automated investment platform with our mission is to leverage modern financial technology to help nonprofits like you all grow their giving. So we are a registered investment advisor, and we can help invest reserve funds, create endowments, receive stocks and crypto. And we were recently recognized by Fast Company as world-changing software. And this recognition was for the ease of use and the disruption we're bringing to a very traditional investment industry. And because of that, Infinite Giving, we believe that all nonprofits should have equitable access to low fees and a smarter investing experience created for you. But I've not always been an investment advisor. So I always like to tell people that I actually have been a founder and executive director of a nonprofit myself. So I've been in a lot of your shoes before. I also serve on 3 boards, one of them for higher education. And I think all of these experiences give me a really unique perspective. And what I do know from a deeply personal experience is that the work that you all are doing is incredibly important. And the work that you are doing is incredibly difficult, because we all know that the need for collective good work never ends. Nobody here does this because it's easy, right? It's a calling, it's a mission, it's a desire to help others and to make a positive mark on the world. So before we keep going, I just want to say thank you. Thank you for the work you all are doing in our families, our communities, and our worlds. We are in a collective interwebs, right, room of doers. And as you know, in nonprofits, the more you want to do, the more you need to have. And that's where money becomes vital to your story. So, as I said, we can't just raise money, we have to be able to manage it. Sound financial practices are not just for businesses or personal finances. Money management is actually a big part of organizational health. So here's an interesting stat. If nonprofits were a country, they would actually have the 5th largest economy in the world. Yet for most of us, the fundraising cycle is endless, and it's actually one of the biggest causes of burnout in the nonprofit sector. So today, one of the things I'm going to challenge you to do is to perhaps think a bit differently about what you can do with the money you've been given, how you can grow your giving in creative ways, and how you can manage it in a way that's going to create a sustainable future for your organization. Because as I said before, financial resilience leads to better outcomes for the people you serve. I think we can all agree on this, right? If your organization ceases to exist, who will do the work? If you decide to launch a new program, but you can't sustain it after 6 months, did you do more harm than good? Financial resilience leads to better outcomes for the people we serve. All right. So if we all want to be financially sustainable, we're going to move into 4 ways that you can move from the scarcity mindset to this financial sustainability. And y'all, it is a journey. And I'm sure we have so many people watching from all over the US, different organizations. You're in different kind of variations of that scarcity mindset. Maybe some of you guys already have significant endowments and reserve funds. All of this is okay. We all start from the same place. Okay. So we're going to kind of work through all these together. So the very first thing we're going to do is build a reserve funds. You may want to go ahead and put in chat, like, do you have a healthy reserve funds? Probably a good bit of you do. Some of you probably don't yet. But this is the very first step that we all want to do. So first off, what are reserve funds? It's an equivalent to a savings account, right? Just like you would for your personal home finances, you may be living paycheck to paycheck, but the first thing you want to do is start building a savings account so that if an emergency comes up or you need funds, you have a place to go to get them without going into debt. It's the same thing for a nonprofit, right? So this is money you want to put aside for a rainy day. But at the same time, it's not just that. It can be more than just what we put aside for a rainy day. These days, reserves are, yes, a part of the emergency funds, but they're also part of a strategic opportunity to create additional financial surplus by growing those reserves through investment. Reserves are really important because it can help you survive through all the unknowns that happen in the nonprofit world, right? Fundraising cycles, a grant that you planned on that didn't come through, a donor who gives every year but didn't this year, inflation, recessions, outside influences, a war in Russia, right? These are a lot of things that we've even experienced in the last 2 years. So if you're watching, you've made it. We're all going to be okay. I know it's still in front of us, but reserves allow you to weather through those challenges in a meaningful way. So when you're looking at these, sometimes you have to ask yourself, can you reduce short-term programs for long-term sustainability? And one of the questions I get a lot is, okay, well, if I'm going to do reserve funds, like how much do we have in there? And there's a lot of different thoughts on this, but best practices for nonprofit reserves, what we teach is 6 to 12 months of operational reserves. So before the pandemic, you would hear 3 to 6 months. Across the board, more and more, I'm hearing 6 to 12 months of operational expenses, because most of us have felt that really strongly firsthand on how important it is and the need for that. So you put these 6 to 12 months of operational expenses, and you can fundraise for reserve funds. You can over raise, right? And have an excess of that. But there's lots of ways that you want to do that. So key milestone for building a sustainable organization is establishing a reserve fund. The second one, so number one, reserve funds. Number two, hedging against inflation. All right, so first you build your reserves. Secondly, you have to hedge inflation, and the way you do that is through investment. And why do you need to invest? It's because reserves are usually held for longer periods of time, and inflation can dramatically impact the buying power of your savings, right? And we have all been hearing about inflation, right? If you've put gas in your car, you've watched the news, we're at record highs, 8.3%. I think most recently it went from 8.5 to 8.3. It probably feels really deeply personal to you because it impacts all of us in multiple ways, especially as nonprofit leaders. So here's some ways where you may be feeling it. Number one, inflation means that you're actively losing buying power. And I know this is a little depressing, but don't worry, we're going to come through the other side, okay? But this is real stuff. So you see inflation in the news and you're like, okay, yes, groceries are more expensive, gas is more expensive, but what does that actually mean for your organization? First off, it means any reserve funds that you've been able to establish, if they're not investing, right, you're sitting in a savings account, you're actively losing buying power. That means the $10 that you had 3 years ago is no longer worth $10 now. Rising wages is another big one. I know a lot of people are struggling with that too. Staff can demand more money right now. And then when they have more money, where do you get that from, right? Are you going to go fundraise for it? Do you get additional grants? Do you cut staff? So there's a lot of questions about the pressure it's putting on development teams because of that as well, right? Because we're nonprofits, you can't just go raise prices on whatever you're selling, right? It's a mission, it's a purpose. So it's putting a lot of pressure on development teams. And I don't think a lot of nonprofits are coming alongside them, giving them these tools to actually help them bring in those additional funds to help balance the loss of buying power and the rising wages. So we talked about this a little bit. Inflation is 8.3%. That means that any money, and you have a savings account, a money market, or a CD, is actively losing value. And I put these average annual returns because emotionally, sometimes we're thinking, I've got this money, we worked really hard for it, right? When you have reserves, if you have a healthy reserve fund, you earned that. It was generously given. There's a lot of responsibility for that. So you want to put it somewhere that feels safe. But when you look at your average annual returns with a savings account, 0.06%, money market, 0.11%, CDs, 0.25%, right? There's variables in there, but those are averages. And then you have inflation, 8.3. Whatever is sitting there every year is actively losing significant value. So it's not actually good stewardship to not manage that money in a way that you're hedging against inflation. Now, is this 8.3% forever? We surely hope not, right? So this isn't a forever thing. I think we're all realizing right now that it's not going to quite adjust as quickly as we would have hoped. But here's something that's interesting to think about too, is that the Fed's target inflation rate, even in the best economy, is 2%. So yes, it's not always going to be 8%. It may go higher, may go a little bit lower. But if the Fed's target bank rate for inflation is 2%, you can see right there that any money in a savings account, money market, or CD is going to be actively losing value. So again, sometimes what feels safe is actually a choice that is losing value, which essentially means you're losing money. So the only real way to hedge against inflation is through investment. And yes, there's some risk with investment, right? But people think about it in a very personal way. People often save for retirement, not in a savings account, but in a 401k or a 403b. And the reason you do that is because you're investing. It allows you to get into the market to hedge against inflation and often make market returns that with compound interest set you up for long-term success. So the same thought process applies to nonprofit reserves. You can look at this chart right here. I love the visibility of it, right? So you can see that. Now, is the stock market scary? Clearly, I'm an investment advisor. I don't think so at all, but there are absolutely ups and downs. So you can see right here, this is just looking at the data from 1920 to 2015, right? And we all know in the last 7 years, even there's been a lot more ups and downs. But you can see there's absolutely ups and downs and variations in the market. That red line is what's really important, and it's why people invest. It's why you have a 401k or a 403b. It's why your donors, your donor advised funds, your foundations, your community funds, all of those are invested, right? The National Christian Foundation, I think they got like $12 billion in donor advised funds. It's all invested. Okay. And the reason it's invested is because it works, right? So you're looking at these average annual returns and that red line goes up. So when we're talking about investing, we really want it to be you to be knowledgeable, at least at a high level, so you understand that emotional decisions do not always match the data. And so we don't want any nonprofit leader to make decisions, especially financial decisions, based off emotions when there's a lot of data that you can look at. And investing can be a great way to hedge against that inflation and get these returns that donors, foundations, and community funds maximize on. And a lot of that, again, this is over, mid to long-term timelines. So here's a way to break it down, because I like numbers and data, right? So say we are all super lucky and we have $10 million in an endowment or reserve, we'll say reserve funds, right? So large organization, 10 million, and you have it in a savings account. So in a savings account, right, you're not going to lose. There's no dips in a savings account, right? Like there is in the market. You're going to get an average annual return of 0.06% in savings. So that means that $10 million in 10 years sitting in a savings account, you're going to make roughly $60,000. Not bad, right? But when you think about how much that $10 million is actually, because we're looking at inflation now, 8%, 2%, wherever we fall in that, that $60,000 is getting you nowhere near maintaining the same value that $10 million was now when you need it in 10 years. Versus, here's just fun numbers to look at, right? So if you say you were to get the average annual return of 8% in passive portfolio, right? We have a portfolio that has average annual returns around 8%. It's called our balanced grower plan. That $10 million invested in a passive portfolio is going to get average annual returns of 8% over a 10-year period, right? So if historically it got that 8% in returns, you would now have $21,589,249.97. So sometimes looking at those numbers, right? And that's illustrative, it's not guaranteed, but it is a real life example of historical data and what it would look like in that. So you can see right there, that's over an $11 million difference. And that's not additional fundraising. That's simply taking the money and the assets that you already have and choosing them to put somewhere, choosing to put them in a place that is very strategic. And that is a great investment illustration for you guys to really understand the meaning in that. So if you remember anything, I always love to have this cute little pink pig. And just remember that banks are not for storing long-term savings. Okay. So as you remember, when you talk about reserves, banks, not for long-term savings. Okay. So the pig represents a savings account, and he's got that little burglar mask on, and he hates earning money. So that's just our kind of fun way of reminding you, banks are not for storing long-term savings. So if you're like, hey, we're not going to use this for a few years, please do not leave it in your bank. Okay. All right. So the first one, right? We had, what was it? Having establishing reserve funds, right? And then out of step 2 was hedging against inflation. And then number 3, we're going to talk about understanding and reducing fees. The way to hedge against inflation is to increase fundraising and to start investing. All right, but once you're investing, fees become really, really important to consider. And I would say, let's see, too many nonprofits don't understand their banking investment fees. I was going to say probably 97% of the nonprofit leaders I speak with who are already at the investing stage do not know or understand the fees that they are paying. Paying high AUM fees means you're spending money on third-party vendors that should be going to your mission and your bottom line. So investment advisors charge a percentage of assets under management. So just kind of understanding even here right where they come from. So AUM stands for assets under management. And when you're looking at that, that means if somebody is managing $10 million, right? Then there's no fee to sign up with an investment advisor, or there shouldn't be, right? And you're going to ask about their fees. So, and assets under management means that they're going to charge quarterly, usually in arrears. That's what we do, is quarterly in arrears. And that means after 3 months, they're going to charge a percentage of whatever money that they are managing for you. So super standard, all registered investment advisors do that. One of the keys is that especially big banks or larger organizations will layer fees on. So as you're talking to people, I always say, make sure you know you're all in. What is your all in fee? What are your transaction fees? What are your penalty fees? What is your AUM fee, management fee? It can be really complicated, and it's a way that folks make you feel like you're not paying as much as you actually are, but it can be quite meaningful. And so, especially with big banks, and I know community foundations are great. If you're putting any money there, though, just remember that they're serving donor advised funds first, and then they're serving nonprofits secondary. And because of that, they have a beautiful program in place, right? But at the same time, kind of like big banks, there's a lot of overhead in that. And so usually there are separate fees for that as well. So just make sure that you understand your fees. So you're not paying money to a third-party vendor that you shouldn't. So here's a little great study that the Common Fund Institute did, and they found that the average investment advisory fee for endowments and foundation portfolios under 25 million is 1.34%. 1% is kind of common as well once you're larger. And I've also seen, I've done RFPs for nonprofits where they thought they were paying like 1.25%. And before we knew it, we looked at all the other fees, they were paying over 2%. So even looking at this average of what in the nonprofit world under 25 million would be a smaller account, that would be 1.34%. A really quick note for this too, which is interesting for you all to know, is that the larger the fund is, the more affordable the price is. It's all kind of a racket. I know it's in the world I'm into. One of the things that you should know is that the smaller your account is, often those higher the payments are. But it doesn't always feel like a payment, which is why folks don't always understand their fee structure. Again, you're not getting an invoice that you're writing a check. Instead, they're actually deducting it from whatever your fees are. So if they're managing, say, $1 million, $100,000, yes, you're getting those returns, but then they're deducting that fee. So if you're getting a 5% annual average return, that 1.34% is being deducted from that fee. So it feels less painful, but it's still money coming out of your budget and your pocket. So here's another great example here. So you have a $10 million endowment. Again, some of us are like, oh, I've got a $50 million endowment. Awesome. Others are dreaming of a $10 million endowment. We talk to more and more folks who that $10 million is a really great target, just because it can kick off $500,000 a year, right? That 5% disbursement can be really meaningful. So take a $10 million endowment. So if you're paying 1.34% in AUM, remember assets under management, essentially that means you're going to be paying $134,000 a year to your investment provider, right? Your investment manager. Versus if you have a lower AUM. So for example, infinite giving fees, right? We leverage technology, so we drastically reduce fees. And so for ours at a $10 million endowment, our fee would be 0.50% in AUM, right? And ours is a flat rate. So we don't do any hidden rates because that's for the birds. I hated that when I was in the nonprofit world. So all that to say is, here's an example. So 0.50% AUM, so 0.50. You also hear basis points, 50 basis points. That's $50,000 a year. So either way, really meaningful money, but that's an $84,000 a year difference in fees. So that means in 5 years, you've spent over $100,000 in fees that could gone to your mission, staff, and bottom line, right? So it's really meaningful money to sit there and look at. High fees are not because they're bad people, right? But it's just simply because there's a lot of overhead. So especially with big banks, independent wealth advisors, there's a lot of overhead, there's a lot of people. Yet academic research has shown for decades, over and over again, that over 90% of active advisors can't outperform index funds over a 5-year period. So sometimes when we think we have to have that person doing that, they're not going to be able to outperform index funds. And that's where you're seeing a big rise in passive investing. So I know I'm going through a lot. And again, we're going to have times for Q&A, but we have first, right? We have our 4 steps. So you're going to have establishing your reserve funds. And then who remembers what number 2 was? Hedging against inflation. So you're investing. Number 3, once you're at a place where you start to invest, because remember, this is a journey, y'all, right? So when you get out of that scarcity mindset and you're able to start building towards financial sustainability, you're going to be able to have a healthy reserve fund. Once you have that reserve fund, your question is, well, where do I put it? How do I protect the value of it? That's when you want to get into investing. And again, passive investing, we're happy to go into it much deeper, maybe in another workshop, but you're not buying all Tesla shares, right? So you want to do something highly diversified, But you want to start to get into the investment world so you can start to hedge against inflation and hopefully even start to grow money from money, right? And that way it can go towards your bottom line. And then the third one is to understand and reduce your investment fees. Way too often we see folks who are spending a significant amount of money on third-party investment fees just because they don't know or understand, or there aren't better options for them. There is a nonprofit here in Atlanta who has a $40 million endowment. And I recently did an RFP for them. And simply by looking at their fees and fees only, we were going to save them over $1 million over a 5-year period simply by reducing their fees. Every nonprofit, no matter how large you are, knows that $1 million is incredibly meaningful, especially your fundraising professionals. They are saying, heck yes, very, very meaningful. All right. So the fourth step and the final step is to grow your asset giving. You don't just want to ask for cash. These additional fundraising opportunities are massively untapped by small to mid-sized nonprofits and sometimes even larger nonprofits. So this is where you get into endowments, cryptocurrency, and stock gifts. All right, ready to learn more about these? All right. First, you need to grow your giving. This is so basic, I know, y'all, but you need to grow your giving by creating more opportunities and ways to give, right? So the easier we can make this for our donors, the more opportunities, the any friction that we can take away that are like, oh, you want to give stocks, you want to give crypto, let us educate you, any way that they want to give, endowments, legacy of givings. We need to be able to put that in front of them, and we need to be able to understand that and also educate our donors about these opportunities. Helps everybody, right? It helps the donor, it helps your organization, it helps the people you serve. So endowments, what do you think of when you hear the word endowment, right? Lots of different things. It is a very misunderstood philosophy and concept and investing strategy, I believe, but it is ultimately, to oversimplify, it's money set aside and invested to create a reliable stream of annual income for a charitable purpose. That's all it is, right? It's money you're taking, it's put aside, it's invested, and then you're pulling a disbursement off of it, that annual income. So really common for endowments is 5%, can be 3%, can be 7%, but generally it's a 4 to 5%. So when I was talking about that $10 million, pulling off $500,000 every year, and then they live infinitely, right? So they're going to continue to give year over year, and usually they grow because they're invested. So that amount of money actually grows, which means the percentage of disbursement grows, and you go from there. So high wealth donors want to give to endowments. How do we know that? Harvard has a $53 billion endowment. Stanford, $38 billion endowment. Higher education has leveraged this kind of giving with incredible success. It's proven, but small to mid-sized charities don't even consider it. And while endowments are not for everyone, if you are able to get out of that scarcity mindset, right? We got to remember our 4 steps. You're getting out of scarcity mindset. You have some reserve funds. You're starting to invest. And that means you're starting to think in long-term goals. So if you're thinking, hey, my organization, we're looking at 10-year increments, or we're able to look at 5, 10, 20 years ahead, and you're visioning that and setting those goals, endowments can be a really great opportunity for you. So we're going to go through kind of what these endowments are. But remember again that it's a beautiful, easy story to tell an endowment, right? Donors want to give that. It's a gift that you give once that lives forever. You're creating a legacy of giving. And a lot of folks here are like, okay, well, I think endowments, and like, you don't want it because if someone's giving you $10 million now, amazing, you would like to spend it. I totally understand that concept, which is again, why you have to step back and you know that your organization's ready for an endowment when you're able to think long-term, right? Because if you're just in this scarcity mindset, then you have that money and you want to be able to use it. But for a donor, a high wealth donor who would like to give larger amounts of money, they want to know that you're sustainable. They want to know that you have reserves and that you're going to exist in 10 to 20 years. And then at that point, you're telling this, like, it really helps with planned giving. There's lots of ways to do endowments. So no longer is it just a true endowment. So I'm going to introduce you to micro endowments, quasi endowments, and unrestricted endowments. And all of these things are what Infinite Giving specializes in. So first off, really straightforward, but a micro endowment essentially means a small endowment. Okay. It means, so I know, like, endowments don't have to be $1 billion. We would all love to have $1 billion endowment, but they can also be really meaningful. It's why we've been talking about a $10 million endowment, but also what if you had $1 million endowment? I talk to lots of organizations who are like, hey, I've got $1 million endowment. Okay, well, if that's 5%, you're still getting $50,000 a year, ideally, right? Every year that you don't have to fundraise, right? And if you're looking at, again, 5, 10, 15, 20 years down the road, that's really meaningful. So micro endowments are not supposed to float your organization, but you can think about them in a way of, well, what if this endowment could fund a scholarship, a program, a salary, infinitely, right? So over year after year, that is one more thing that you don't have to fundraise for that speaks to sustainability. So a micro endowment just makes it really accessible. Infinite Giving, the minimum endowment gift is $25,000. Is that going to be meaningful money for you? No. But at the same time, if it continues to grow and your donors can add to it, right? Over time, this micro endowment can become quite meaningful. So I would always encourage folks who are able to think longer term, thinking in decades, think about a micro endowment and how it can endow, again, a position or a program. You're not looking to endow an entire organization. Unrestricted endowments, again, if someone's wanting to give you a restricted endowment, a lot of it is sometimes just education, right? Educate that donor, explain to them why restricted endowments are quite limiting. Sometimes restricted endowments are really well intended, right? It's, hey, I want this money to go towards this program. Well, what if 20, 30, 40, 50 years down the road, there's not that same need for that program? A lot of times I speak to folks in the medical community, right, who are battling different diseases. And they're like, yeah, but if ultimately we want to provide a solution to this and we're solving that and they're in an endowment and it's restricted, then yeah, if it was a restricted endowment and then that disease is cured, you can't access those funds. So again, donor education. Unrestricted means it is a protected amount of money, but that disbursement can be used wherever the need is most. So, right? So if you have a $10 million, you're putting it aside, it's kicking off $500,000. In an unrestricted endowment, you cannot touch that 10 million, but that $500,000 every year can go where the need is most. Can a donor still make a request? Can you honor that? Yes, of course, those are conversations. You're building relationships with these people and their families, but unrestricted is where you want to go. It gives you a lot more flexibility. And finally, a quasi endowment. Quasi endowments are really popular right now, and there's a lot of really great reasons. And one of them is that they are not restricted and you can access the capital if you decide. So a quasi endowment is not donor created. It is actually organizationally created. So your organization can choose to create an endowment, right? So you have to have an investment policy statement. We have one of those for free, a template that you can download on our website, infinitegiving.com, under resources. Don't go pay somebody to do it, right? We have a template. It's gone through all of our attorneys and all that. But in your IPS, or an investment policy statement, you can talk about a quasi endowment, right? And you're like, here's the restrictions and here's where you can access it. But you as an organization are setting up an endowment. It can be from excess reserves. You can now fundraise for it. It's a different conversation with high wealth donors, because when you have an endowment, it speaks to sustainability. But a quasi endowment, again, organizationally created, means that if 20, 30, 50 years down the road, you decide that you actually need that $10 million for a different reason, as long as it goes in guidelines with your IPS and you get full board approval, you can pull that $10 million back out to be used in different ways. So lots of flexibility in there with endowments. So educate yourself, and remember, don't just think about a true endowment. There's lots of unique opportunities between micro, quasi, and unrestricted endowments. So endowments build sustainability, and they give it a legacy and fundraising. And it's a beautiful thing, helps with the planned giving conversation, right? They already have, hey, seed an endowment, and then they already have the brokerage account where they can put it in their will. So there's a lot of really great opportunities to leverage endowments when you are moving into long-term thinking. All right, so we got asset giving, you got endowments, stock donations. Stock donations are untapped, and they are the most tax efficient way for donors to give. And a lot of folks actually do not realize that. So actually we'll go right back here. So here's a stat for you. The reason it's the most tax efficient way is because donors don't have to pay long-term capital gains taxes when they give you stock directly. So the worst thing you can ever ask a donor to do is to sell a stock and then send you the money, because that means they're going to pay long-term capital gain taxes on that. Number one, you're making them work for it. Two, you're going to make them pay taxes on it. Three, it means you get even less money donated to you because you're only going to get whatever's left, right? And if you think about where most high wealth donors keep their wealth, it is not in a savings account. Because again, they understand inflation, they understand the market, so they're all investing, right? And so when you look at that, the kind of education opportunity you need is for them to be able to give you stocks directly. And this study by Russell James showed us that asking for stock gifts in addition to cash can increase contributions by 55%. So that's a really impressive number. I did read the study, and that is what they found, which was super interesting. But it's not like your magic bullet, right? But it is something to think about, because it can be really quite significant in growing your giving and making it really easy for them. So another thing to think about with stock gifts is often folks are like, well, yeah, we'll take it, but no one really gives them to us. And then usually I say, great, well, like, how are you asking for them? Or how is the donor able to gift it to you? So if you just have like a D2C listed on your website, it's not a great experience for a donor. And usually there's a lot of manual back and forth of, okay, well, there's that information. And then they got to go to their broker, and you got to connect them to your broker. And there's a lot of back and forth. And then what do you do? So I am plugging Infinite Giving really quick, just for a second. But in this, I just want to let you know that there are some different ways. So first, you have to have a brokerage account to receive a stock gift. So open up a brokerage account. We can help you do that. But in stock gifts, one of the things that we did is we give you a custom URL for your nonprofit that allows you to put it into a button, or you can link it into a website, and it gives them a really easy form, and then it automates everything for you. So there's no calling, there's none of the back and forth. And when anything's in writing and it goes to their broker, it means that they have to act on it immediately, versus there's a lot of delays when you're calling. So the SEC requires them to act in due time. And then we automate everything. So you liquidate it and reinvest it automatically. But stock gifts, you need to be able to do that. You need to make it easy for the donor to gift you those. You need to educate them on why it's the most tax efficient way to give. And on average, stock gifts are significantly higher than cash gifts. So it's a great thing to think about for growing your assets. And of course, we have cryptocurrency, right? So according to a Fidelity charitable survey, crypto investors are actually more likely to make charitable contributions than the general population. So is it an outlier? Absolutely. Sometimes I talk to people and they're like, I have to do crypto. I'm like, it is an outlier, right? It is not everybody who has access to this, but there is a lot of importance where you're seeing an incredible amount of very tech savvy young people making lots of money. And it has been proven to be a very philanthropic group of folks. So besides the convenience of not having to convert assets into cash by being able to accept cryptocurrency, there's also significant tax benefits for the donors, again, as well with crypto, because the IRS considers cryptocurrency similar to property. So donors are not required to pay capital gains taxes on crypto giving either, and they receive the immediate income tax deductions. More than 90% of nonprofits lack a way to accept crypto donations, let alone define crypto giving as part of their development strategy. So it's a great untapped opportunity. And again, is it the silver bullet for most organizations? No, but I think it's something that we need to educate ourselves on and know that it is very philanthropic. And if you ask me, in the next 5-10 years, this is going to be even more mainstream as it currently has, if you think about the growth it's had in the last 5 to 10 years. So you should be able to be thinking of ways where you can educate your donors and give them opportunities. And again, you've got private equity, like you got a lot of people in crypto, but you also have a lot of young people. We've even been talking to organizations who are asking about receiving NFTs too, right? So this is the world we're going into. Okay, so we're at the end, right? Your journey to financial sustainability. And again, it is a journey. You're going to build your reserves, hedge against inflation through investment. Please do not leave your money in a savings account, money market, or a CD. And we can talk through, you can always reach out to your investment advisor. You can reach out to Infinite Giving or somebody else, but talk through like, what money should you invest? Where should you put it? How should you do all that? We can all help you understand and reduce those investment fees. Please don't overpay third-party folks. And then finally, grow that asset giving with endowments, stock gifts, and cryptocurrency. So as this final aspirational data point here for you, Infinite Giving believes that nonprofits could create an additional $5 billion each year simply by changing their financial practices. So, and that's not raising another $5 billion. That's simply taking the money that you already have and moving money from savings, CDs, and money markets into investing, and then also reducing those fees. And by doing that, $5 billion, imagine the ripple effect that has in the communities and the work that we are all doing. So again, I'm Karen with Infinite Giving, and I believe we have about 12 more minutes for questions. So I hope all of that was helpful, but I am here to answer, and I think Jay's gonna be able to read some questions for us. So, and if y'all have anything that you've been thinking about or would like to know, definitely pop it into the Q&A. And we can go from there.
Thank you so much, Karen. Really appreciate it. And I know that a lot of people do as well here in the audience. So keep those comments coming. I know she will appreciate that. Someone asked if there's going to be a recording available. I'm sorry if I didn't say that earlier. Yes, we record these sessions and they are placed in 2 places. One is on the YouTube channel that DonorSearch manages. So after the session today, do take a look at DonorSearch on YouTube, and you can see other sessions in the Mastermind series there. Additionally, you can look at the DonorSearch website, which is at donorsearch.net, and there's a whole library of content there as well. There's also a slide deck. Some have asked about that. That slide deck will be sent to you directly by DonorSearch after the presentation today, so you can look forward to that. And with that, let's jump into the questions. So some came in early, Karen, and you may have touched on these already, but I think it's probably fair to review a couple of these things. So one question was the perennial, what is an index fund?
Oh, that is a great question. So when you're talking about index funds and ETFs, so essentially the reason those are really important on a really high level is it is essentially the stock that you are investing in, and it is not a single stock. So it is not like a Tesla stock or an Apple stock, but it is made up of multiple stocks. And the reason that's important is because it is diversifying, right? So in the S&P 500, right, that's considered an index fund. If you have an S&P 500, which a lot of people, if you haven't heard of that, that's okay too, but that's like a very common reference that you'll hear in the investing world. And that's made up of 500 different companies. And so the reason that's really valuable and why it works really well, reducing your risk, is because if one company is doing really well, but another company is doing poorly, they're balancing each other out, right? So by having a pool of 500 companies, if several are, not doing great, again, it's reducing your risk. So you're not having the ups and downs of like a single stock.
Thank you for that. We've got a question from Will, who had asked earlier, what does that statistic mean that 90% of advisors can't outperform index funds?
Right. So that means that you're going towards active management versus passive management. Active management is when your investment advisor is doing daily trades, or maybe you are a dabbler in investing and say you're on the app Robinhood and you're buying and selling, right? Or it's like the market's down, I'm going to sell, and then I'm going to buy, and then I'm going to sell. So active trading, it's very strategic, right? And there's a way to do that. But what happens is those decisions are often very emotionally driven decisions, or you're in your top 10% of active wealth advisors who actually do it really, really well. So all the data has shown it's about passive investing, and passive investing is essentially the buy and hold strategy, right? So it's like, hey, we're going to go into a diversified portfolio and we're going to buy these ETFs and index funds, and then we're going to hold it for a long period of time. And essentially what it's looking at is all the activity usually does not end up nearly as good as when you buy and hold and just let it ride and you sit out on it. So for like our clients, right, the market is down. If you've not been in it, it's a great time to get in potentially. But at the same time, I tell them, just like Warren Buffett says, I'm like, just don't look at your account. You're not in this for the daily tradings. You're not in this to get a quick return in 30 days, which a lot of brokers do. You're in this for the long term. Nonprofits are not doing day trades. So you don't want to have to pay active wealth advisor fees when most nonprofits are looking at a passive investment. If you're under a $50 million, $100 million fund, passive investing is usually the best strategy for you. There's also a little, you can Google it, but I think Houghton College, I think it's in the Wall Street Journal. There was a big deal because little Houghton College, no relation, I wish it was, but Houghton College up in New England, and they outperformed Harvard. And it was a really big deal, and it was in the news. And how did they outperform Harvard? Because Harvard has some of the best, wealth advisors and financial money manager people that there are. They had a new person who came in and they put everything into index funds and ETFs, and they outperformed all the fancy folks. So it's just a different way of looking at it.
Sure. Rachel had asked what your thoughts are on establishing a crypto trust.
Oh, that's a good question. Rachel, email me at karen@infinitegiving.com, and I'm happy to go into it. I think there's just a lot. Crypto is, right, it's very volatile. It's definitely something to think about and work through depending on your long-term goals and strategies. And so I think it could be a good fit for some people for sure. Even for us, when we are allowing people to receive cryptocurrency, we actually liquidate it immediately and reinvest it into a diversified portfolio for them, just because we serve as a fiduciary, and usually it's their risk tolerance is not a good fit to hold crypto long term. But anyway, it's a very email me and we can talk about it some more.
That's another great word for all of us to hear again, fiduciary. Would you mind defining that? Because that's an important consideration also, isn't it?
Absolutely. So a fiduciary, any registered investment advisor serves as your fiduciary. And so what that means is we have a moral, legal, and ethical responsibility to put your needs above our own. So essentially what good people should do, right? But the SEC requires that. We could go to jail if we don't do it. And it just means that, hey, I'm not going to do what's best for whatever fee I'm going to get for you guys, right? So even when I talk to people and they're like, hey, I've got $10 million of cash sitting in my account, I don't say, great, give me all your $10 million, right? Because I'm their fiduciary. And so instead we go through and say, all right, what are your operating expenses? What do you want to spend in the next 12 to 18 months? All right, then put something else aside in a savings account that you can dip into it. And then once you receive this certain point of excess over that, that's what you want to invest. And we take those steps because we serve as your fiduciary. It's like we essentially put your needs above our own.
Right. We had a question from Laurel earlier that I think you may have answered, but this is a shout out to Laurel. It's about crypto and the process of turning it into cash. Laurel, if your question wasn't answered, or if you'd like that reviewed again, once again, Karen, would you share your email address in addition to the URL so people can reach out to you?
Sure. Our URL is just infinitegiving.com. And my email is Karen@infinitegiving.com. So happy to answer any questions. And then, yes, there are several organizations out there that can help you receive crypto. I always say, look at the transaction fees. There's also, I know often I've seen 5% or higher transaction fees, which is significant, or there's really high minimums. At Infinite Giving, we have a 1% transaction fee that is passed to the donor, not the organization. So once you have a brokerage account with us, we allow you to see crypto and we actually liquidate it immediately. And then we put it directly into your checking account.
Now, I know we have to be judicious with time, so I'm going to share a couple more questions with you. But if anyone hasn't had their question answered, that's one reason why I asked Karen to repeat both their URL, which is also on your screen, but also her email address, because as you can see, she's been pretty generous with her time today, but also in terms of this discussion in the field. And just on a personal note, when Karen, you talked about this, about the gifts of stock and how many people don't recognize it, I can tell you, going back in the field, for me, it's 25 plus years of trying to evangelize for organizations, talking to donors about making gifts of stock, because it's in the donor's interest, and it still continues to be something we need to evangelize for today. But the range of different opportunities to give, all those that you've been sharing with us today, is now so broad and important that it's great to have you as a resource so that we can be up to date and continue to make these opportunities available to donors. So I hope everybody will write down both the URL and that email address and take a look at the site just to learn more about this, as well as to help you in your journey to make sure these opportunities are available for your donors. We had a comment from I think it was let me see, from Philip, who had said, is donor permission needed to set aside 10% of each gift to create a reserve?
No. So I think there's some variations on that, but generally speaking, no. So is the gift designated, right? So it all comes down to, is the gift designated? So if the donor, we have to honor what the donors want, but generally speaking, no. If a donor goes on and gives you $100 and you want to put $10 towards a reserve fund and $90 towards different programs, you can do that. I think often what I've seen people do are like, hey, we want to be really intentional about our next campaign and we want to educate our donors about building sustainability. They will say, hey, like if you're going to raise $1 million, then you say, hey, we're raising $1 million, but we ask that every donation you give, you increase by 10%, and that extra 10% is going to go into our reserve funds. So there are ways to build campaigns around that where you can over fundraise, or you just say, hey, we're going to raise $1 million. And in that $1 million, we're going to do this percent for a program, this percent for this, and this percent for reserve funds. But unless it's a designated gift, then it's up to the nonprofit to be able to use that money where they deem it should be used best.
And this will be kind of a random choice, so hopefully I'm making a good one. But we have a question from an anonymous attendee that always both is exciting and a little scary, who said, you mentioned that the AUM is higher when an investment is a smaller dollar amount. How much funds, or how many, what in the way of funds would you suggest an organization would need to allocate for starting an investment endowment fund?
Great question. So thank you for that. The fee is higher. So it's like when you have the $1 billion endowments, their fees are incredibly low. If you are investing with $25,000, sometimes you can't find anyone to take you, or your fees are going to be 2 to 3%. It's all kind of a racket, right? And so for Infinite Giving, one of the ways that we're democratizing access to investing is that we do have a minimum investment, but it's only $25,000. So for us, we set that and we felt like $25,000 was enough to where you were starting to build sustainability. You have to have a good reserve fund, right? And in that, and so building up that reserve fund, once you have that, then that's where we start to say, hey, let's start putting that aside. So for us, every brokerage is going to have a minimum amount. Sometimes they're millions of dollars. Sometimes they're hundreds of thousands of dollars. Our minimum is $25,000. But again, it's up to your nonprofit and looking at your operational budget and how you're going to fundraise. But again, those reserve funds, ideally that target is somewhere between 6 and 12 months of operational funding.
Thank you so much for all of this. Really great information. Again, the recording will be here so you can share it with colleagues. Please look for that both on YouTube under the DonorSearch YouTube page, but also on the DonorSearch.net website. You can find that under the resources tab. This will be there in the next 2 days. And then additionally, a copy of the slide deck, which will be really valuable as you share that with colleagues. That'll be coming to you via email. So be on the lookout. We also have other sessions coming up soon. And before I say goodbye to Karen and all of you, I want to make sure that you know about them and you can attend or put them on your calendar. Those include a session with Nick Solog, Messy Data In, Messy Data Out, how to set up your organization for success. That's on June 23rd. And then with Larry Johnson, the author of the 8 Principles, on creating a fundraising culture that works. That's on June 28th. And then we also have coming up on the podcast, a great discussion with Krista Slade, who has been instrumental in setting up a lot of the major international fundraising programs from Hong Kong to Melbourne to Oxford. So I hope you'll give that a listen when you take your walks around the neighborhood or do your dishes or do all the other things we do while opening up our ears to some of the stories of fundraisers in our sector. So with that, again, our thanks to Karen. Thank you so much, Karen, for sharing today. We really appreciate you.
Thanks for having me, and thanks for everyone for attending. If you have any questions, again, please reach out to us, Karen Houghton, and we actually, Infinite Giving is one all-inclusive platform, so we can help you with crypto, stocks, endowments, and investing. And we'd love to work with you and help weigh in, help you figure out how to get started.
And we appreciate all of you for being here and hope that you'll join us again in one of these future programs. So until then, stay healthy, and we'll look forward to seeing you very soon. Take care.
Take care.